Michael Saylor has said never sell your Bitcoin more than 400 times on camera. His orange dot Sunday posts, week after week, Bitcoin acquired, Bitcoin held, sell a kidney if you must, but keep the BTC. He said that in February 2025. On May 5th, on his company's Q1 2026 earnings call, he said this: "We will probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it." The next day, his company filed documents with the SEC, a prospectus supplement. It lists in plain language that Bitcoin sales are an authorized use of proceeds to pay dividends. Those are not two different signals. That is one signal sent through two channels, one verbal, one legal. And the legal one is the one that matters most. MSTR dropped 4% after hours. Polymarket odds of strategy selling Bitcoin by year end jumped from 13% to 87% overnight. His announcement didn't just move his stock, it crushed an entire industry. Dozens of companies built their whole business model on the assumption that Saylor would never sell. When Bitcoin Moses said maybe, they all repriced at once. That is the price of having a crisis of faith. Saylor's shaken faith also repriced Bitcoin. In the hours after his announcement, Bitcoin slipped below $81,000. Maybe he should have sold a kidney instead. What happened? What does it actually mean? And why did it spook an entire industry? Let's get into the forensics. Here is what we're going to cover today. 1. What Saylor actually said and what the filing actually says. 2. The financial structure that made this inevitable. 3. Why an entire industry repriced when he said it. And 4. What this signals for every retail Bitcoin holder watching strategy as a confidence indicator. Subscribe. This channel is the only place where this mechanism gets explained. Let's be precise because precision matters here. On May 5th, Strategy's Q1 2026 earnings call, Saylor said, quote, "We will probably sell some Bitcoin to pay a dividend just to inoculate the market and send the message that we did it." That is not a hedge. That is not a hypothetical. He said probably. He said we did it in the past tense, referencing a future action as if it were already decided. CEO Phong Le followed immediately with, and I'm quoting again, "We will sell Bitcoin when it's advantageous to the company. We're not going to sit back and just say we'll never sell Bitcoin." That line is more important than Saylor's because Phong Le just told the market the ideology is over. The never sell doctrine is gone. Now it's math, and the math changes depending on the price of Bitcoin. The next day, Strategy filed a Form 424B3 prospectus document with the SEC. In the use of proceeds section, it lists general corporate purposes, including the acquisition of Bitcoin, and the payment of cash dividends declared by the board of directors. That is a legal document filed with a federal regulator. It explicitly authorizes using Bitcoin sale proceeds to pay dividends. Not a podcast, not a tweet, a filing where lying is a federal crime. Now, Saylor spent the weekend calling it a nothing burger and saying they would buy 20 Bitcoin for every one they sell. Whoever told him that echoing Hillary Clinton's messaging was a good idea might have been the same person who suggested to him that selling BTC would be no big deal. Here's my forensic read. The volume argument is probably fine. Strategy holds 818,334 Bitcoin at my last count. Selling a small slice to fund dividends does not materially change their position. But a covenant is not a volume agreement. A covenant is binary. You either hold it or you don't. And the market understood that immediately, even if the weekend podcast tour tried to explain it away. That is what the filing says. But here is the question nobody on the earnings call asked. What made this inevitable? That is the mechanism, and it is next. Let me explain how Strategy actually works, because most coverage misses this. Strategy raised capital through 3 channels: common stock, convertible notes, and a series of preferred stock instruments, including STRK, STRF, and most recently, STRC. STRC is a perpetual preferred share. It launched with a dividend, and today that dividend sits at 11.5% after 7 consecutive monthly increases. It pays $100 par value with a mandatory cash dividend. Strategy cannot suspend it without triggering a default. Against those obligations, Strategy now carries $1.5 billion in annual dividend payments. They have roughly 18 months of cash coverage. After that, they need to either raise new capital or sell assets. And their primary asset is Bitcoin. Here is the mechanism that creates the pressure. Strategy operates using a metric called MNAV, their market capitalization relative to the value of their Bitcoin holdings. When MNAV is above 1.22, they issue stock and buy Bitcoin. When it falls below 1.22, the math says sell Bitcoin instead. Right now, MNAV is approximately 1.23, 1 lonely basis point above the trigger, 1/100th of 1%. BitMEX research puts the odds at 70% that MNAV drops below 1.0 in the second half of 2026. If that happens, Bitcoin sales are not a choice. They are a mechanical requirement of the capital structure. Here is the sentence I want you to sit with. The never sell commitment was always conditional on the price of Bitcoin holding up. The covenant was not theological. It was leveraged. That is the quiet way they made it work. And once you see it, you cannot unsee it. 1 basis point. 70% odds the trigger breaks in the second half of this year. Now, here is the part that nobody framed correctly after the earnings call. Saylor was not the first person in his sector to sell Bitcoin. He was just the only one who said whose sale mattered. Subscribe, please. This channel is where the mechanism gets explained. Not the narrative, the mechanism. Here is what the financial press mostly got wrong after the earnings call. They framed this as a strategy story. It was not. It was an entire sector story. In 2025, dozens of small public companies built Bitcoin Treasury strategies explicitly mirroring Saylor's model. They accumulated Bitcoin on their balance sheets. Their valuations carried a premium tied directly to the same assumption. Institutional conviction: never sell, accumulate forever. Nakamoto, Empery Digital, Sequans, companies you've probably never heard of, built on the premise that Bitcoin Moses had validated the model. Here is what happened to them before Saylor said a word. Nakamoto, which raised $710 million last year, has seen its share price collapse more than 99%. Empery Digital stopped buying Bitcoin in September 2025 and has been selling. Sequans has sold more than half its entire Bitcoin position to pay down debt, and its stock is down 51% over 6 months. The market watched all of it and shrugged. Nobody called it a crisis of faith. Because it wasn't. They were ordinary companies making ordinary financial pressure decisions. Saylor is different. Saylor was the prophet. Never sell was not a policy at Strategy. It was the founding doctrine of an entire institutional Bitcoin accumulation movement. Every one of those companies built their model on the assumption that he meant it. When he said maybe, the doctrine collapsed, not just the stock. This is not contagion. That is theology repricing in real time. So the question you should be asking is, who else was standing on that same assumption? And the answer is an entire industry and a few 100,000 retail Bitcoin holders who thought the institutional floor was solid. That is next. This is the pattern I documented in the token trap. Institutions build trust with retail. Retail uses institutional behavior as a confidence signal. Then the institution reveals its constraints are financial, not ideological. The token trap is available now on Amazon and at thetokentrap.com. There's a link in the description. Here is the most uncomfortable question. Hundreds of thousands of retail Bitcoin holders have used Strategy's behavior as a confidence signal. Every Sunday orange dot was a data point. Bitcoin acquired. The smart money is buying. The smart money is holding. You should too. That ritual told retail that the institutional floor was solid, that there was a buyer of last resort with an ideological commitment to never sell, not just a financial one. Now the CEO says, I believe in math over ideology. The question is not whether Strategy is still holding Bitcoin. The question is, what did retail think they were following? A financial position or a covenant? Because those two things have just diverged. The confidence signal was never the Bitcoin. The confidence signal was the commitment. And the commitment just became conditional. Retail was not following a treasury strategy. Retail was following a doctrine. Doctrines don't have basis point triggers. Financial structures do. Strategy has a financial structure. It always did. The doctrine was the marketing. The structure was the reality. And the structure has 18 months of cash coverage and a dividend it cannot suspend. You were never the investor. You were the confidence floor. Michael Saylor did not betray Bitcoin. Bitcoin Moses built the largest corporate Bitcoin treasury in history. That is real and it matters. But the never sell covenant, the reason I call him Bitcoin Moses, was always a function of the capital structure holding. When the structure developed pressure, the ideology developed conditions. An ideology with conditions is not a covenant. It's a term sheet. You were never the investor. You were his confidence floor. If you want to understand the mechanism behind all of this, the book is The Token Trap. 617 sources, 23 victim interviews, a forensic breakdown of exactly how institutional capture reshapes what it touches and what that means for everyone downstream. There's a link in the description. Subscribe, hit the bell, leave a comment. It helps the algorithm find me. The channel is all of 3 months old right now. I'll keep doing the forensics. I'm Dana Love, PhD, and I'll see you in the next one.